Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at Monegenics.com. Monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Why would I buy whole life insurance when I could invest in an index fund or some other investment and make much more money? So I've received some version of this question. I don't know. I can't even, I've lost count of how many times I've received some version of this question over the last 20 years or so. And it always sort of comes from the same place. And there's always a pretext to this. And I debated whether or not to publish an answer about this, but I figured I would, just because I've answered it so many times already. Why not answer it again? And this time it's sort of, I guess, immortalized. Maybe I won't have to answer it again. So this comes from the financial gurus. I won't name names because it doesn't matter who. They're all kind of come from the same place, and they always say, like, whole life insurance has a terrible rate of return. That's why you should never invest in it, and it's a scam because it doesn't give you the same kind of returns that you could get somewhere else. And you fill in the blank. Some advisors will say index funds because those are widely available. Others will say growth stock mutual funds or growth and income stock mutual funds, something along those lines. So I guess the first issue is addressing, when somebody says rate of return, my question is compared to what? So what do you want to compare the whole life insurance policy to? If it's a participating whole life, this is most whole life policies are participating, which means that it participates in the carrier's performance, annual performance, and they pay, and the company pays dividends each year at the end of the year. So you're not just getting, a guaranteed return, you're getting the guaranteed return plus whatever dividends the insurance company can pay. So the return on those cash values is going to be comparable, or let me put it this way. You should expect the return on your participating whole life product policy to be very competitive against fixed income or fixed interest type of investments, savings accounts, maybe bond funds, but corporate bond funds, definitely, and then other similar types of money market funds and things like that, right? Obviously, compares favorably against cash. So that's kind of how you should look at it. Now, what if that doesn't necessarily mean that that's what it will return. That's just sort of the slot that it fits in. That's I guess if you're going to put it into a group, that's the group it puts in. So people are saying, like, oh, you should never invest in this, bank CDs. That would be something else to compare it to. So you put it in a slot like that, and you say, like, oh, don't buy whole life insurance because it doesn't compete favorably against some other investment. It's almost like saying, well, you could just substitute whole life insurance for these other investments that don't compete favorably against stocks. So, would somebody compare a bank certificate of deposit against an S&P 500 index fund? Probably not. Like, that's sort of ridiculous. Like, how many comparisons do you really see? Or a conservative, long-term corporate bond fund that pays 3 to 4%, maybe 5% or something. You don't really see those kinds of comparisons. Nobody tries to put that head to head and say, like, oh, you should, instead of investing in this bond fund, you should invest everything into the S&P, or instead of putting any money into this bank CD, why are you doing that? It pays a low rate of return. You should put that money into an S&P 500 index fund, because that's a superior place to put it. Because the number is higher. Number is higher, therefore that's where you should put your money. Number is higher. Right? Isn't it obvious? When the number is higher, that you just look on the spreadsheet and see that the number is higher. That's what you put all your money. I mean, it sounds like such an idiotic sort of argument, partially because it is, but it just sounds like sort of this really stupid sort of thing to say. Yet, when it comes to whole life insurance, this is basically the argument on rate of return. Right. And so I think the first thing you look at is say, well, compare, like, what am I comparing it to? And then secondly, like, well, also what has whole life insurance actually returned? So we don't really like to compare against index funds, but if you were actually, and by the way, I don't think people should be making this decision of, hey, should I invest in an index fund or should I be buying whole life insurance? Like, that's such a bizarre kind of analysis to do. Like, I don't think anybody should be making financial decisions like in real life. Now, we've done it analysis before. We've seen how, like, this is what the S&P has done, this is what bond funds have done, and this is what whole life insurance has done. But as a comparative tool to see kind of where it falls, not as a decision-making tool of it. See, like, this outperforms this, therefore you should just not even bother with this and put your money here. That's so totally bizarre to me that anyone would do that, or anyone would advocate that anyone would do that. So with that out of the way, what are the actual returns? The returns on whole life insurance depend on a number of things. It depends on when the policyholder buys their policy. It depends on how long they hold the policy for. It depends on the company they buy it from, and also because different companies, obviously, they can pay different dividend rates over time. So it depends on the time period of when you buy your policy. So those are like all important factors. So you don't really go into saying, like, what's the rate of return on whole life insurance, because it depends on a lot of different factors. And there's a range, but even that range changes depending on the decades. So, in the 1960s, you would give a different answer to that question versus if you bought a policy in the 1980s versus the 90s versus the 2000s versus now. This is the 60s, 70s, 80s, 90s, 2000s, 2010s, 2020s. It all gives you all different answers. So, and here's, by the way, it doesn't really matter what decade you bought it in if the goal is to, give you that hedge that life insurance gives you, that financial hedge. So you don't really care about so much about that. And this is where I think it sort of trips some people up, because the spreadsheet warriors, they're always looking for, like, how do I optimize? They want to min-max. In other words, they want to minimize their expenses and maximize the number that shows up on the spreadsheet. And, first of all, life's not a spreadsheet. But secondly, it's such, again, a really bizarre way to make financial decisions. And just totally, like, basically discounts this element of financial risk down to zero. And I guess, survivorship bias, the people who stick around and somehow, like, avoided anything bad ever happening to them, those are the ones that are the loudest on the internet. Or just the people who are bullshitting and they know they're just, they're just engagement farming. They'll say whatever they have to say, even if it's not true, to get the likes and the shares and the reposts or whatever. So this whole idea of, rate of return, what has whole life insurance actually returned during different decades? So I actually did this analysis a while ago, and again, it depends on the decade. So if you go back, and everybody, now I'm going to pick a couple of different examples. Now, this is not exhaustive, but this is a couple of different examples. So I'm gonna look at the VUSTX, which is the Vanguard Long-Term Treasuries Fund. So if you look at the VUSTX, using historical price data that I got from Yahoo Finance, the price of VUSTX, when I did this, I could go all the way back to May of 1983. So April, from like January through April wasn't available. They sort of sometimes like chop off how far back you can go. The price back then of that index was listed at $1.12 per share, adjusted for splits and dividends. So by the end of, and I took it all the way to December of 2012, just to give that was, trying not to pick an arbitrary date, but I just happened to have returns on certain whole life products up to 2013. And I chose up to 2012, 2013. So I chose that as sort of a date to take it to. And, that it's just shy of 30 years. You could basically look at it as a 30-year return, if you're just going to round it up. And 30 years is a long time. 30 years is a long time for most people to be holding any kind of an investment. If you're going to get a good return out of something, it'll happen after 30 years. Okay. The price of the VUSTX, $1.12 per share in 1983, and then fast forward to the end of 2012, it had risen to $9.83. So if a person had bought, and most people, the way they would have bought the index, had it existed, or if it had been around in the same, if people had been able to sit and do what they do today, which is make monthly contributions. You get paid, you make your monthly contribution or weekly contributions. We do monthly contributions. It's pretty easy. You get paid at either at the beginning of the month, end of the month. The calculation would change beginning, end of month, but it's going to be pretty close. So you say sometime during the month you make your contribution out of your paycheck or whatever it is. And you do that, you just contribute monthly, because that's how most people do it. They contribute monthly into their 401k plans or retirement plans, or even if it's just a regular, investment account, they just contribute month after month after month. That's how most people save. They save monthly. So if an investor had saved, set aside, 100, it didn't matter how much, $100, $500, the return would be the same. But if they saved us, monthly, and they kept putting stuff away monthly, over 29 years, they would have received a gross return of roughly 8%, that's the gross return. So the real return would be net of taxes and administrative fees inside of retirement plan. Or if they did this through an advisor, which a lot of people, especially back in the 80s and 90s, most people used advisors, and advisors back then charged, 1 or 2%. Someone charged 2 or 3% as an asset management fee. But if you just took the 1% fee, you'd have to subtract out that from your return too. So the investor cashed out that entire investment after 29 years. The net after-tax value of that account, assuming the investor could have deferred federal income taxes the entire time until the end of the holding period and claimed one exemption, during that time in 2013. That investor would have gotten a return of about 6.5%. If they had a 1% management fee, you could knock that down to 5.5%. If it was 2%, 4.5%. So depending on what kind of financial advisor you're working with at that time, your return could have been 4.5%, could have been 6.5% if you did it all yourself. Most people didn't do that, and most people, you do have DIYers who will do that, but a lot of people didn't do it all themselves. But so that would have been your return. So the other index that I looked at was the Vanguard 500, the old, the I don't know, the standard, the gold standard, right? The Vanguard 500, VFINX. So the price shares of VFINX in April of 1983. Just take it to 1983. It's $8.14 per share, adjusted for splits and dividends, of course. By the end of 2012, the price of VFINX was listed at $114.85 per share. So if our hypothetical investor, again, invested consistently in that index, in the S&P 500 index, month in and month out, just never missing never missing a contribution, from 1983 to the end of 2012, his gross return before taxes would have been about 8.5%. And that's a month in, month out. Now, if you took an annual, if you did what a lot of people will say is like, oh, they'll look on a calculator and say, oh no, it returned 10.5%. That's what the calculator says. It's because that's the total return, assuming a lump sum made at the beginning of, in this case, 1983, a total lump sum amount, and then riding it all, making no further contributions, and riding it all the way to the end of 2012, then you would have gotten 10.5%. But that's not how most people invest. Most people don't save. They don't have like $100,000 or $300,000, and then they just invest at the beginning of the period and then wait 30 years and then cash it out. That's not how most people do it. Most people save. They go to work, they get their paycheck, they save month after month after month. So the contributions that they're saving in the first 10 years are earning, over the first 30 years are earning interest for 10 years. The contributions that they're making, in year 25, 26, 27, 28, those only have like a couple of years to compound. So when you average it all together, it's not the 10.5% that they're making on all that money. The blended total return is going to be much lower, because as you go on, the closer you get to your end date, those last contributions are not earning as much. So it's about 8.5%. And at first blush, 8.5% seems like, I think some people, I guess, think that that's kind of low. Especially compared to let's say a US, the VUSTX, which was a treasury fund, during that time. However, the way to think about this, I think, is, stock markets, equity markets are very volatile. The value in compounding returns, and people talk about the value of compounding returns in equity markets. It's true. Compounding can make a big difference, but compounding only works when you do not suffer large losses. When you do suffer large losses, compounding, you could have, quote unquote, negative compounding, right? So if you lose a lot of money, it takes a lot. You spend a lot of time retracing those losses to try to get to new new all-time highs. So the value of compounding, again, it only works when you do not lose a lot of money. So you have to take that into account. Anyway, so if you, in this specific instance, investing in the S&P 500 index, if the investor had taken again, cashed out at the end of the term in 2013, the net after-tax return on the VFINX investment would have been roughly 6.43%. Now, to be fair, most people don't take their retirement savings as a lump sum. So if the investor took systematic with income withdrawals, and I worked out the taxes, because all this historical information is thankfully is widely available. You took systematic withdrawals, and the average effective tax rate was, let's say, 15%. 10. Some people are in the 10%, some 15, some are going to be in 20%. If you make six figures, you're going to be in 20, maybe 20%, maybe 25, depending on your deductions. You might, but at a 15% average tax rate, effective tax rate, what you pay on, we have a progressive income tax system, but you have your effective tax rate, let's say 15%. This would have resulted in a net return on the treasury fund, on the bond fund, of 6.8%, and on the stock mutual funds of, let's say, 7. Let's say, I think I calculated 7.22%. So 6.8% for the treasury fund and 7.22% for the index funds, which is not bad. It's not bad at all. So it's not, the 10, 12 or whatever percent that people say it is, but it's, that's still a pretty decent return. If you had any financial advisor involved in that at all, I realize index funds, a lot of people, they do it because it's cheap. You don't necessarily need an advisor, but a lot of people still pay an advisor for other things. They're not necessarily paying for the index funds, but the advisor's still taking his 1% fee on the portfolio. So if you had used a financial advisor at all, the return from there goes down. So if it's a 1% fee, again, that 6.8% turns into 5.8. If it's 7.22%, the 1% fee turns into 6.22%. So you're looking at, maybe 5, maybe 6%. If you did it all yourself with no advisor, you're not paying anybody fees, still making around 6 to 7%, somewhere in that range after taxes and so on. And this is, by the way, this is assuming that your 401k administrative fees are in check and you're not really paying anything for those either. Some 401k fees are really high, so you're paying, especially on a small 401k plan with the small companies. Those 401k fees could be quite high, and your returns are going to be eroded from that too. So this doesn't take into account administrative fees or anything like that. Nothing, just the taxes. And if you start adding financial advisor management fees, if you start adding 401k fees, stuff like that, the return goes down from there. What about managed funds? So some people say, there's certain financial gurus, if you just did, growth stock mutual funds, that will be the solution. So let's look at that. So let's see, look at, let's see, investment. When I first got in the business, the stock fund to own was the American Funds Investment Company of America, AIVSX, which was one of the, if not the highest performing managed mutual fund that you could buy. And a lot of advisors that I worked with really psyched up about this one because it was like you could show high double digit returns from this thing. So, and it's been in existence since 1934. So it had a really, really long track record. So that was, even Morningstar lists this, the return on this since inception as, having a good, nice double digit returns. So, if again, you go through in 1986, which is as far back as I could go on Yahoo's finance data. So in the beginning of 1986, the price of AIVSX was $2.04. And I took this forward a number of years to right up to 2020. Well, November of 2019, the share price had risen to $39.83. So that means for every $100 per month invested in that fund, and don't assume any taxes or no other fees, the value of the investor's shares adjusted for dividends and splits amounted to about $184,000, $185,000, somewhere in that range. So it translates into a total compound annual return of about 7.89%. Now, the fund itself advertised a return of over 12%. But again, you're investing month in, month out, and over long periods of time, very volatile stocks, very volatile mutual fund. You're getting about 7.89%. Not bad, but not like, it's not like blowing anything out of the water. And if an investor is paying an average effective tax rate of just 15%, the net return drops to under 7%. You're looking at, we could actually just look at, let's see, what is it, 7.89 time, take out your effective taxes, it's 6.7%. So that's what your net return would be. You do the same thing. You could take systematic withdrawals, you get slightly higher return. You might get closer to 7%, if you're just taking systematic withdrawals. So again, these are the returns that just assume, and I'm assuming a 15% tax rate, not a 20 or 25. So a lot of people are going to be in a high, if you make a decent income, you're going to be in a 20 to 25% income tax by the time you hit state and federal. But this is just federal income tax. Now, everybody on the internet, I realize, I get it. Every person on the internet, nobody pays taxes. Everybody lives in a state that doesn't have an income tax. Everybody's making 12%. Everybody's got $30 million saved up in their 401k. I get it, okay? But in the real world, most people are saving month in. Oh, by the way, and everybody on the internet inherited some money from their uncle and could afford to put lump sum in 20 years ago and just hold it. They didn't have to make any more contributions. So that's how they got the highest returns possible. So, but in the real world, people are saving every month. They're paying, they're paying taxes, right? They have to pay taxes on their withdrawals. They may not take lump sum withdrawals, but they're going to take systematic withdrawals. They're still paying taxes. What about term life insurance? So this analysis, we're talking about, 6%, 7% returns, regardless of whether you went with a treasury fund, whether you went through, and used a stock fund, a managed fund, you're still falling in that 6-7% return range at a 15% tax rate. Now, if you do really, really well, so all the financial gurus say you're going to have millions of dollars in your 401k plan, millions of dollars. Well, if you have millions of dollars, you're not going to be in a 15% tax rate. You're going to have a really high income. At some point, you're going to have a high income. Because if you have millions of dollars and you have to start taking withdrawals from that retirement plan, which in traditional 401k plans and IRAs, you have to start taking your RMDs. So you're going to, at some point, you're going to have a high income. Unless you just didn't do very well. So either the gurus were wrong and you did not earn a really high rate of return, or the gurus were right and you did earn a high rate of return. And if you didn't earn a high rate of return on your investments, maybe you don't have a really high income, a retirement income. And if you did earn a high rate of return, chances are you probably are going to have a higher rate of return or a higher income withdrawal, which therefore means you're going to have a higher tax rate, right? You can't have it both ways. You either do really, really well, and if you do really well, then you're going to have a higher income. If you don't do really well, then the plan didn't really work as advertised. So you got to pick one. Okay, you can't ride both sides of the fence. So this analysis assumes a low tax rate, no financial advisor fees, no other fees, no 401k, low to no 401k or retirement fees, plan management, administrative fees. We still haven't talked about term life insurance. All the gurus are saying okay, so just buy term and invest the difference. Buying term means there's a cost for term, right? So when you buy whole life insurance, that's already included in your premium. When you buy term and invest the difference, it's not just the investments, right? You're also buying term, so there's a cost for that. So if you're buying term, we look at what was available. So my analysis on this one was done back in 1984. So what kind of term policies were available in 1984? Yearly renewable term was very common. It was a 5-year renewable term insurance policy. And then, and you also had a level premium term to age 65, but it wasn't as widely available. And in fact, the FTC in their cost disclosure report on life insurance, they published this report back in 1979. They noted that the early year premiums for the term to age 65 are significantly higher than traditional renewable term, which is, probably why it wasn't as popular back then. And, of course, the internet wasn't available back then. So it's also, kind of difficult to run comparisons. You can't, like today, you could run quotes and just, run a bunch of quotes and see what, you could compare term policies pretty easily today. That kind of stuff didn't exist. So you kind of have to go back and use the available data, which it's published data. You just have to use the wet thumb method because you can't just search for it on the internet anymore. So if a policyholder had found a company willing to sell them a term to age 65, he wouldn't have had to pay the rising premiums, but he would have had to permanently reduce the amount available to him to invest for those 29, 30 years. Right. So that's part of the, as the yearly renewable, buying a yearly renewable term, as those term premiums rise, it eats into your ability to invest the difference, quote unquote, so it's buy term and invest the difference. But as the term premiums go up, you have less and less to invest. So as more and more investable dollars are used to pay the term insurance premiums, it results in a lower investment account balance in spite of achieving a really good rate of return, both from the, from whatever index fund you buy or managed fund you buy. It doesn't matter. If more of your money has to be diverted away from, your savings to pay for term premiums, at some point people say, well, I would just drop the term, right? But the whole point of buy term and invest the difference is that you carry the term insurance for 10, 20 years, really 30 years. If you're in your 20s or 30s, you're going to carry the term insurance probably for 30 years, right? So some people say buy a 20-year term. If you buy a 10-year, it's not going to be long enough. You're not going to be able to save up as much as you need in 10 years to quote unquote self-insure. So you're going to buy term for 20 years or 30 years. Well, those premiums are going to permanently eat into your ability to actually quote unquote save the difference, right? So you have less money to save. So even if you get a high rate of return, you just don't have enough to save. If you bought whole life insurance, all of those go into the whole life premium. So if you buy term and invest the difference, you have to carry that in. Your term premiums are effectively a 100% cost. There's no return on those term premiums. So, for example, if an investor had a choice of paying whole life premiums of $1,000 a month or buying term insurance for $100 and investing $900, the total return calculated on the $1,000 outlay for that buy term and invest the difference strategy is going to be dragged down significantly by the fact that the $100 of in term premiums, the $100 out of the total $1,000 that's budgeted for this is a total loss, right? And so that loss keeps rising annually, right? If you buy an annually renewable policy, that loss keeps going up because it's $100 first year, it's $105 next year, it's $107 the next year, and so on and so forth. On a level term premium, it's $100. Probably instead of paying $100 on annually renewable term starts out low. So if it's $100, a level premium is going to probably be like let's say $150 or $200 because it has to be higher to level out the premium. So it's something that I think that gets ignored a lot in these kinds of discussions. So depending on the cost of that term policy, and again, that depends on your age, how long you're buying. A 10-year term is cheaper than a 20-year, which is cheaper than a 30-year. But if you're 32 years old, you're probably going to buy a 30-year term policy. So, that's it's eating into your return. So, your net return on the buy term and invest the difference, again, because it eats into your ability to save. And when you're looking at the total amount, term insurance has a cost. And so, your buy term and invest the difference strategy, overall, your total aggregate return on that whole strategy is, it knocks it down. Instead of making, 6 to 7%, maybe you're making 4 or 5%, you might make less depending on the cost and so forth. Maybe you're not making, maybe it's more like, 6.5 to 7% instead of 7 to 7.5, or 6 to 7. It's maybe it's 5.5 to 6.5%. So, and of course, again, if your tax rate is higher, the return is lower. If you have management fees, the return is lower. So there's a lot of things that can start chewing into the headline number. But everybody wants to look at the headline number because that's the sexiest thing to look at, right? If they're like, oh, it's an 8% return, 8% is higher than whatever it is. 8% is higher than 4%, so just take the 8%. But that 8% can be whittled down quickly. That headline number that headline percentage rate gets whittled down pretty quickly in a number of different ways. So as an investor, that's the battle, is to try to not have that happen. But there's certain things that are just unavoidable, right? So there are other costs that get factored into this if you're trying to do it a different way. So how does that compare to whole life insurance? Well, again, it depends on the time period. It depends on who you bought the policy from. It depends on how much you bought it. It depends on when you bought it. Just a number of different factors go into that. So I do have data from two companies, well, more than two companies, but MassMutual and the Guardian Life Insurance Company of America, have both done comprehensive long-term historical dividend studies on their whole life insurance products. Each company using different start dates for their policies, but it gives you a general idea. So MassMutual has perhaps the most comprehensive data that I've seen, and it shows they had a 40-year at the time I did this. And they keep running totals, but at the time it was a 40-year return for all the policies studied. That they looked at, and the rate of return on their policies averaged somewhere between 4.8, 5.86, 5.89. If you looked at a say a 20-year or a 30-year return on some of these whole life products, you're probably looking at a 4 to 5% return. Somewhere maybe 4.2, 4.5, some companies 4.75. So that would be like a 20-year or a 30-year return, depending on the carrier. And you're going to see this across the board. So at like Penn Mutual, you're going to see, a 20 or 30-year return. The 20-year return is, might be, 3.5 to 4, and maybe at a 30-year return, it's going to be 4.5 to 5, somewhere in that range. So you could get a 20, and again, depending on the policy design, depending on the risk rating, if you're preferred, that 3.5 to 4 becomes, maybe 4 to 4.5 at the 20-year mark. If you have a lower rating, obviously that kind of eats into the return too. But that's true on term insurance, you pay more if you're rated, or you have a standard or substandard rating, or if you're smoker rating or something. That all changes the cost of the insurance side. But, at Penn Mutual, Guardian, Mass Mutual, New York Life, those companies can all, if we're looking at the historical rates, of course, it depends. It depends on, where we're talking, what we're talking about. Historical dividend rates have changed over time. At today's dividend rates, you could very easily squeeze out somewhere between 4 and 5%. On some carriers, maybe 3.5 to 4.5%. Over the long term, 3.5 is getting kind of low on some of these carriers. So, but you could definitely get, somewhere between 4 to 5%, somewhere in that range. Over the long term, as dividends rise, you could see, somewhere between 4 and 6. You might see higher if the dividend rates go high enough. But the point is that, let's say on an average of somewhere between 4 and 5% long-term return. This is net. So this is, net of taxes, all your insurance costs and expenses. There's no management fees going along in there. They're not charging anything. So this is net return on cash surrender values. During the time period that I looked at, where you were going from like 1983 to 2013, Northwestern Mutual was on a tear. And their policies had actually returned 7%, a net return on cash values of 7%. So, compared to VFINX and VUSTX and AIVSX, the returns on those, in the 6 to 7% after tax versus the 7% on a, Northwestern Mutual whole life policy at that time period, you'd have been just as good, all things considered, you'd have been just as good in, just buying whole life insurance and holding it for those, let's say 30 or 29, 30 years. You'd have been just as good, and it had taken essentially no risk, right? No investment risk at all, because you weren't investing, you were just buying life insurance. Now, I say this cautiously because that doesn't always happen, right? There's a 30-year return on whole life insurance that matches a return on an equity index during a really good run, right? And a bond index fund during a really good run, and even an actively managed fund during a really good run. That doesn't always happen, right? So, but it did happen during that time period. And again, 29 years, 30 years, that's a long time for any investor. For most investors that I know, they consider a 30-year time horizon to be a pretty long time to be fully invested. And, whole life insurance compared very, very favorably during that time period. Now, is it going to do that if you bought it today and you fast forward 30 years? Is it going to do that? I don't know. It could. We know it can. We just don't know if it will. And I don't think it's really... I think the bigger issue is that you don't really go into it thinking about it that way. There's a lot of people who think about it that way. I think I'll buy this instead of doing this other thing. No, don't do that. Don't do that. Just, if it performs that well, if your whole life policy matches or outperforms your equity fund, just I don't want to say consider yourself lucky, but consider it just a major win, right? But don't expect it to happen. If it returns like 4%, 4.5%, I call that a major win. If it does 7 or 8%, I don't know. I guess count your blessings, I guess. Historically it was capable of doing that. Going forward, I don't know if it would do that. However, I don't buy life insurance with the expectation that's going to outperform equity investments. I know that it has in the past. I'm just not buying it because I think it's going to do that in the future. I would just buy equity. If I want to invest in equities, I'm going to invest in equities, right? If I want to have like partial ownership in a company, or I want to participate in the profits of a publicly traded company, I'm going to buy equities. I'll buy equities. I trade options contracts, stuff like that. That's where I'm going to take risk and hopefully get really good returns. With my life insurance, I want to buy because I want downside protection. That's what I buy life insurance for. Downside protection. I don't want to take risks with that money. That's my safe money. So I'm not going to be taking risks with that money. And whatever the return happens to be, that's what it is. If for whatever reason it's a 3% return, I don't think it would be that low. But if it's a 3% return, fine. It's a 3% return. That's money I didn't risk. That's money that was there for me when I needed to buy a new car, my car broke down, I need to buy a new one or fix it or something. That's money that's there for me when my kid does something that I wish he hadn't done, and I need to bail him out of something, and I need cash, and I don't want to be cashing out my equities because they're doing really well, right? So I don't want to cash out equities that are performing really well. Likewise, if my equities are down and I'm temporarily losing money on my equities, I don't want to cash them out either. So I need someplace to draw money from, and my whole life policy is that's where I'm going to be drawing my money from. Or if I need money for something else, lots of there are a lot of financial risks and a lot of financial needs that have absolutely nothing to do with investing or the financial markets at all. And they have to do everything with like the normal everyday life stuff that happens where you need money and you have a choice. You can either take it from a place like that. If you have a whole life policy, you can take it from a place like that. Or, and by the way, when you take that, you don't cash it out. You borrow against your policy so that money continues to grow. And you use it, and then when you're done, you pay it back or you replace it. If you happen not to need it, you just put it back. So you can take it from a place like that, or you can cash out your equities. And if you're doing well, you're cashing out on equities that are performing very well. And if you're down on your equities, you're cashing out and locking in a permanent loss. Those are not really very attractive options. You don't want to cash out of something that's doing really well. And likewise, you don't want to cash out on something that's not doing well. So, I wouldn't do that. And I don't see the argument for doing that. I don't understand why anyone would take that approach and want to do that, have that as their plan for, if they need money. So the rate of return question is, why would I do that? Why would I buy whole life insurance when I can just buy an index fund or some other managed mutual fund or buy blah, 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 whatever stock and get a higher rate of return? It's because sometimes rate of return doesn't matter. I'm not chasing rate of return. Sometimes rate of return doesn't matter. I know my whole life policy can return in the future, long term, could do very well. It could do very well. It could theoretically perform just as well as an index fund. A lot of people will say it probably won't do that. It might not do that. You shouldn't bank on that. And I don't make comparisons on my whole life policy to my equities. My equities are separate. I invest in equities. I do all kinds of different kinds of investing. But I know that my whole life policy could do really well. And that kind of excites me. I like the idea of that happening. But if it doesn't do well, I'm not disappointed in it, right? I'm not disappointed if my dividend rate falls, over 10 years or something. And because my whole life policy is still doing what I need it to do. It's still, it's still functioning the way that it's supposed to function. And its function is to protect me from downside risk. And it's doing exactly that. It is doing exactly what it's supposed to do. So that's the reason why I would buy a whole life policy and I'm not really think about it like I'm buying this versus buying equity funds or something. I'm buying whole life insurance and I'm buying equities. In fact, sometimes I'm borrowing against my whole life policy to buy the equities. So it's not an either or. proposition. It's an and proposition. I'm buying whole life insurance and I am doing other things with it. So anyway, that's my take on it. And I know this was a long one, but I hope that it helps or hope somebody out there, hope you learned something. And I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.